Hello and welcome to the program. This is Business Incorporated and boosting them. Welcome to a brand new business week. On the show this afternoon, Nigeria's annual inflation rises to 13.7% in April. That's from 12.8% level in the month of March. And crude oil prices surged 2% today on Nigeria's pipeline vandalism, as well as credit rating. Moody's downgrades credit rating of 3 Middle East oil producers, Saudi Arabia, Oman, on Bahrain. Now let's get started from home, where the latest inflation data from the Statistics Office shows Nigeria's April inflation of the core inflation up from 12.8% last month to in March to 13.7% last month. The data released early today shows that the Consumer Price Index recorded strong increase for the third consecutive month. According to the data, the 0.9% increase can be attributable to spillover effects of structural constraints from electricity rates, as well as petrol and kerosene prices. More impacting on the index are the prices of imported items such as vehicle spare parts, which continue to have ripple effects across many divisions. From the world of oil, crude prices jumped more than 2% today to the highest level since October last year on growing Nigerian oil output disruptions. The new prices defy Goldman Sachs' outlook, which sees an almost 2 years of oversupply ending and flipped to a deficit. Brent crude futures were trading at $48.71 per barrel, up 88 cents, having surged earlier by as much as 2%. U.S. crude futures were up 85 cents or 1.8% at $47.06. Supply disruptions of about 3.7 million barrels per day have been wiped out of a glut that pulled down prices by 70%. Here in Nigeria, output has fallen to its lowest in decades at around 1.65 million barrels per day, following several acts of sabotage by militants in the Niger Delta. In the Africa's mining sector, Caledonia Mining says its Zimbabwean subsidiary Blanket Mine, with 49% ownership, has sold the country's treasury bills worth $3.2 million. The company says the sale is part of the company's drive to dispose of non-core assets and use the additional funds to develop the Blanket Mine. Meantime, the Zimbabwe's Defense Ministry says it's partnering with Africa Chrome Fields on a new exothermic smelting project in the Kwekwe region. The new technology is able to produce ultra-low carbon ferrochrome in just 45 seconds. In another development, Kefi Minerals announces that the Ethiopian government has confirmed commitment to invest $20 million for equity in the Tulu Kapi gold project. The investment will secure the government in Addis Ababa and estimated 20% of Kefi Minerals in a project value at about $100 million. Crude oil is in the news. Prices reaching their best levels of 2016 in recent weeks. Let's listen to this interview with Jill Malandrino, who is the VOA Channels TV business correspondent in New York. He sat down with Jeremy Baker of Baker Boards to discuss supply and demand fundamentals at the world of oil.
Crude oil inventory continues to build, and the Saudis are actually dialing up production. Jamie, why do you think that we're seeing an increase in oil prices? Because they really have recovered since the February 11th low.
Well, they've certainly moved quite a bit since February. I think that in some degree the movement is attributable to trading contracts that were expiring in the late February, early March period, and so people were having to cover their short positions. I don't think outside of the trading community anyone ever thought oil would get below $30. And so much of that bounce, I think, relates to financial considerations rather than supply and demand considerations. But another thing that I think is driving this is I think a lot of the significant producers are driven by their political considerations as much as they are by economic considerations, and so they are not responding to forces in the marketplace necessarily as they are thinking about how to achieve their political or strategic objectives.
Now, in the United States, going into the summer season, it's considered more high demand as more Americans are driving. Do you think that at this point demand may outpace supply?
I think demand will increase, and I think it'll come into better balance. But I don't think that those curves are likely to intersect globally. At least they won't be likely to intersect this year. The EIA is suggesting that inventories will continue to accrue at about the million barrel a day rate through the end of this year and into the first quarter of 17. Having said that, I think you will see some movement in price. Some of this is momentum driven, and some of it relates to increasing demand, whether it's in China or the first quarter traditionally is a slow quarter for the U.S. economy, and so I think that there will be some demand driven growth in the price curve.
And what about from $45 to $50? Is that the appropriate level based on supply and demand right now, or do you think it should be trading higher?
Well, that's kind of a speculative question, but I think that if you survey many of the experts who are following this very closely, the 1 year projections are in the $50 range. So I think that for this to move from $45 to $50 is still a 10% move, but it's not out of the realm of possibility.
Well, it's just like when we talk about stocks. Stocks don't have to go up forever. There's really no reason that oil should have to be at $60, $70, $75 a barrel. If this is the appropriate level based on supply and demand fundamentals, then this is where it should be.
Well, sure, that's true, but you've got to take into account the effect of inflation. I mean, at $35 a barrel or $45 a barrel, the 1973 equivalent is something like $2.50 a barrel. So I think that you're right that prices don't necessarily need to go up, but they are really at pretty low levels historically speaking, inflation adjusted.
Okay, thank you very much, Jamie.
Thank you, Joe.
For Channels TV in New York, I'm Jill Malandrino.
Yes, Jill Malandrino there in New York. There's still a lot to talk about. The world of oil making the headlines. Let's come back to you after the break with that.